Hello, everyone. Welcome to this TradeStation webinar. I am broadcasting live from the city of Houston, right here in Texas. It's a pleasure to be here. Top of a cloudy day today here in Texas, but not very cold, so it's a good day. It's a good day to join a webinar and learn about options strategies. So I want to thank everyone for taking time out of your schedules and be here to learn a little bit about not only option strategies, but also about the TradeStation technology that allows you to really be a little bit more efficient in placing those option strategies and analyzing the markets. So yes, we're going to pass the microphone over to Brandon in just a moment, and we're going to talk about ratio back spreads in a bit. I just need to go through some of the introductions and some of the disclosures about this class, just to make sure that we all are aware of them. Just keep in mind that every symbol and idea that we talk about here is for educational purposes only, that these are not recommendations of TradeStation. Also, that active trading is not suitable for everyone, and past historical performance is no guarantee of future results. So we talk about examples or performance. A lot of the performance we talk about are just examples. There's no guarantee of future results. And also that online trading is not suitable for everyone. Those are things that we need to be aware of. If somebody needs a little bit more information on these disclosures, please go to www.tradestation.com/important information. All right. Brandon is our guest speaker today. He is not affiliated with TradeStation, although he brings a lot of knowledge in trading option spreads, specifically the ratio back spread, which we're going to talk about today. He's also a trader, and we're glad to have him so he can share his expertise with us. One thing that I wanted to point out before I pass the microphone over to Brandon is that I just linked everyone to this article, which is titled Trading Big Market Moves with Ratio Back Spreads. Let me go ahead and link that article again one more time here in the chat. The article is pretty much a summary of what Brandon's going to talk about today. It has a video, it has some theoretical examples. It also has workspaces that you can download directly here from the article. So right here on the left-hand side, you see a button that says download workspace, and you're able to bring in some of the tools that Brandon is going to utilize during the webinar today, and you can make those part of your TradeStation platform as well. All right, I'm going to stop my share and mute my microphone, and I'm going to go ahead and welcome Brandon. Brandon, thank you for joining us today. The floor is all yours, my friend.
Thank you for having me. Appreciate it. I'll go ahead and share my desktop and get this started. And anyway, welcome everyone. I appreciate you being here. And yeah, basically my background, if you're not familiar with who I am, an independent contractor. I trade and I mentor and I teach trading and investing. I've been doing it for over 25 years, been trading over 30 years. I'm a charter market technician, which means I basically have a master's degree in technical analysis, where I attained that back in 2008, I think it was. So I've learned all the different types of market analysis and how to use the different tools that TradeStation allots for you. I've also, I got in the industry originally as a retail broker, where I was on the sell side, basically selling stocks to people, and I hated it. So I moved into back office operations. And what I did there was order flow. I handled the order flow for the brokerages as well as retail customers and institutional customers. It was kind of interesting. I got to actually trade a bit. Then I moved into a private hedge fund, where it was a very small hedge fund out of La Jolla, California, San Diego area, basically. And I managed $50 million AUM, so it's small money. When it comes to hedge funds, that's small amounts. But anyway, so I traded that for a few years and then ended up getting into education, where I was mentoring other people and then became an instructor trading. Now I just trade for myself full time, and I work, helping out people learning how to trade the markets. So I try to turn my experience into something positive to help other people. And hopefully that's what I'm going to be able to do for you today. So from today, speaking of which, if you have any questions, let me know. I'll try to answer them as we go along if they're pertaining to what we're talking about. If not, then I'll do an open Q&A at the end of the session. That way I can answer everything for whatever it is that you have. As Jesus mentioned, there's also the Options Education Center which has tons of information on the different option strategies. And Jesus and I have been hosting, I've been a guest host with Jesus, a program called Options Replay. And Options Replay is something that goes on every other Monday. You'll have to check the schedule. Actually, if you go out to TradeStation.com, under the events, you'll see the schedule out there. And we basically do kind of a post-mortem on trades to kind of demonstrate how certain trades could be set up and utilized. So strategies such as these, which we're going to talk about today, are ratio back spreads, and how we can use those, or what in the options replay, you'll actually see them having been deployed, and you'll learn piece by piece how to utilize the TradeStation Option Station Pro, as well as TradeStation's platforms, to be able to affect those positions in your own personal accounts. Okay, so that's kind of cool stuff that they're putting out there, lots of education. I'm glad to be excited to be a part of it, and hopefully we can help you. So getting into this, basically, we're going to talk about what ratio back spreads are, the fundamentals of them. We're going to talk about call and put ratio back spreads, and it's an alternative to trading the regular long call and long put. So we're going to talk about a little bit about some of the advantages and what they are, how they differ, and how to work them when you might want to use them. We're going to talk, obviously, a lot of people want to focus on rewards and why they're so good, but we also need to understand what risk we are assuming when we take on certain positions in the markets, especially when you're selling options. If you're not familiar, one of the biggest risks of selling options is assignment. So there are things you can do to reduce the risk. There are things you could do to minimize the possibility of it. Or, sometimes you just have to accept it. And when it comes to trading, whether or not it is options, stocks, futures, or Forex, and I've traded everything and anything, crypto, I've done CFDs, not inside the US, they're illegal, but I've worked in accounts overseas and lived overseas. But basically, whatever you trade, if you want to get greater rewards, you must accept greater risk. You cannot have one without the other. They go together. So raising rewards, raising risk. Lowering risk, lowers rewards. So we'll talk about those risks and rewards, and you have to weigh it out to see, is it worth it for you to take that type of trade? And we'll do some practical application. As I said, we'll take a look at some of the favorable market conditions for doing ratio back spreads and see how we can utilize those opportunities. And actually, I just realized, I think, here I am on the TradeStation page already anyway. And let me close out a few other things here while I'm thinking of it. But if you go, as I said before, learn, well, it looks like we got options replay coming up on January 6th. So you'll be able to join us there. But anyway, going into the options education section, there we are. And you can see that there are strategies that are available, and you can go through and click through the different strategies. I'm going to click right here on ratio back spreads because I realize there's a tool that I'm missing currently on this computer. And it's cool because I can get it real quick in front of you. Download the workspace right there. I can download a workspace that we will be using in this class. So ratio back spreads, click on it, zip, and it's now on my other screen. I'll go ahead and open it up. And there we go. And I have the ratio back spreads workspace. So we'll get to that in just a few moments. There's also, I don't know if you saw it, actually, I didn't bring it over on this screen, but if you download that workspace, which is available for you for free, there's also a PDF that explains how to utilize those workspaces as well. Okay, so let's see, get back into the agenda here. So what are ratio back spreads? What the heck are they? Why would we want to use them in the first place? Well, if you take a look, this is the risk profile. Hopefully, if you've been trading any options, you're familiar with risk profiles. It allows you to visually see how the position either makes profit or loses in the markets. And these are available in your platform as well when you do your analysis on Option Station Pro. So if I go, which I happen to have OS Pro open right now, and I didn't look at the markets the last few minutes. We just had the Fed announcement, but that's okay. Let's just take a stock like, I don't know, I'll just use QQQ. Use the ETF. It's just as easy as anything else. And there we go. And I'll just click on, we're going to buy a little bit of time here. So I'll go out 90 days. And at the money. We're trading about 530 right now, so I'll just buy a call at the money. The screen is off. Oh, I know why. There it is. Now it's fading. Now, if I go to analyze, there's my risk profile. And again, it just shows me how I could potentially make profits based on the price of the underlying moving up or down and how much I would lose. So it gives me all that good information about that particular position. So we have our risk profiles here, and basically ratio back spreads are multi-leg option strategies. Multi-leg meaning there are more than one option that is being applied. What I just showed you was buying a call. That's a single leg option strategy. And multi-legs, basically the reason why you use multi-legs and multi-leg options as a whole, they're usually called spreads. So anytime you have more than one option, it's can refer to as a spread. And they have a lot of different names. If you were to go out to some of the strategies that are out there, for instance, under search, you can see that I can actually search for, let's see. Yeah, I'll do bullish limited risk. That's fine. QQQ. And let's see, run a search. And it should show me single, vertical. It'll show me a bunch of different types of strategies out there. And anything that has more than one option, for instance, this vertical spread, I'd be looking at a 521, 522 put. That is a spread because it has more than one option. So a ratio back spread has multiple options. It's multi-leg. And we use these when we're expecting a really big move in the price of the underlying security. Well, that would normally happen around earnings. A lot of times earnings offer really big moves in price, or even today. For instance, I just mentioned that there was a Fed announcement just a few moments ago, if you weren't aware. So if I do bring up QQQ on a chart, actually, I'll bring it up here, that's fine. And I apologize. I don't know why my computer is running a little slow today. There we go, QQQ. And you can see we just had a very large price move in the Qs. That is to the downside. Okay, and this is on a, what about a 5-minute chart? We just moved from 60.60 down to 60.18. Lots of volatility, obviously, around this. So we just had almost a 40-point move to the downside here in just a matter of 10 minutes. So when you get major announcements such as Federal Reserve meetings like this, where they just had announcements, I didn't even see what it was, or you get earnings announcements on a particular company, there's a high probability that you're going to get a large move in the price of the underlying security. So for instance, on the Qs, if I go to a little bit, oh, this is the SPX, sorry, that's not the Qs. Qs will look about the same anyway. I forgot I switched over on a different chart here. Okay, well, I'll come back to that in a little bit. It doesn't matter. Anyway, earnings, news causes big moves. That's typically when you're going to want to be using these types of trades. So the name comes from the ratio of options used. Okay, the ratio is usually 1 to 2 or 1 to 3, meaning you sell one and buy two, or sell one and buy three of the same type of option. So you're using these when you're expecting a very large explosive price move in one direction or the other. You want to have a bit of protection and limited risk. Now, there is risk, or you can lose money. Obviously, if you look at the risk profile, there's red. But we're looking for a very quick move in one particular direction or the other. I just lost my connection. That's what happened there. Bear with me a moment, and I'll log back in. So basically, if you're doing a bullish price movement or expecting a bullish price movement, you're going to want to use calls. And if you're going to be doing a ratio spread where you're expecting downward price movement, you would be looking for a put, ratio back spread, basically. And bear with me again. You know what? I'm just going to switch accounts here. So anyway, getting back into this, we're using this for a large particular move in price, one direction or the other. We're using calls for the upward move, puts if we were expecting a downward move in price. So this can offer really good profit with defined risk, as I mentioned before. Again, when we take a look at the risk profile, and let me just bring up one as an example. Again, if I go into OptionStation Pro, I'll go to options. I happen to be on the Qs. I already put in to buy one. I'll actually change that around a little bit. And let's just say we're going to do, if I'm bullish, I'll sell the at the money call and then buy 2 out of the money calls. And there we go. It shows right here, back spread 1 by 2. So I can do 2, I can do 3, it's whatever you choose. And again, when I go to analyze, make sure I only have the 1. This is the risk profile. And the way I did this is going to be unlimited potential profit. And you can see it says max profit unlimited. And then my max loss is going to be defined. My max loss would actually occur if the options expire at the strike price where I bought. Okay. Now, depending on how you set this up, it can be done for either a debit, which in this case, I'd be buying at $12 or $1,298. Or you could be doing it for a credit, depending on where you select the options. So again, if I go back here, clear up this trade, and perhaps I sell slightly in the money at 525, and then again, buy. Yeah, now this is still going to be a debit, but that's okay. It's a much smaller debit, $9 instead of 12. But again, I can adjust, and there are times it could be actually done for a credit. So it does have limited risk as defined. You could have low or no cost entry. As I mentioned before, if I do this on a security, a different security, we'll do some scans and show you how it can work better for actually a credit versus a debit. So what you're doing is you're selling one option, and you're selling an option offsets the cost of the long options. Of course, there's always still risk. So as I said, you can do it for a debit or a credit. Now, when you buy options, one of the reasons why we do spreads in general is because it helps to offset the Greeks. If you're not familiar with the Greeks, when we take a look at an option chain, you'll see I have the Greeks, Vega, Theta, Delta, and there's a couple others, Gamma and Rho as well, but we're going to focus on these 3 in particular, Vega, Theta, Delta. Vega is volatility. That's how volatility will impact the options pricing. T for time, theta is a measurement of how time will impact the options pricing. Delta is direction, and that is how the direction of the underlying will affect the options pricing. So these are risk parameters because it tells you how much you might be able to profit or how much you might actually lose based on time, volatility, and direction. Well, if you don't like them the way they are, that's the problem. If you buy one option, again, I'm just using the Qs as an example, you could use anything, but if I buy this 530 call, I have a delta of 0.6, I have theta of negative 0.14, and I have a vega of 1.04. As you get more advanced in options trading, you'll learn what those things mean. And if you don't like those, maybe I don't like the time exposure, or I don't like the volatility exposure, I can offset that by using another leg. So for instance, if I were to go ahead and let's say I sell an out of the money call, okay, what that's now done is it changes my vega, my theta, and my delta because I'm buying one and selling another. Oh, maybe that isn't, that's weird. Keep getting disconnected here. So basically, the reason why you do multi-leg options is to offset those Greeks. So again, if I go to analyze, let me see if it'll analyze right now. There it goes. Oh, it's not loaded up yet, but once it logs on, should be in just a moment here. It should populate. There we go. Delta, theta, vega. And by using multiple legs, this is just one right here. So let me go ahead and do the analysis for the other one. Analyze. There we go. You can compare the two. Notice my delta 57 is now only 19. My theta, my time value risk is from 14 down to 2. And my vega went from 105 down to 3.24. So I've been adjusting basically the amount of risk I'm getting from volatility, time, and direction. So I'm also reducing the potential profits from that as well. Okay. So see, how do I manage the spread after exit? Oh, we'll get into that. Don't worry, we'll get to that. So yeah, volatility, it gets kind of offset a little bit because when you're doing this particular spread, the one I just showed you, it changed volatility drastically. However, when you're doing the ratio back spread, it's not going to change it quite as much. The long options will actually have a little bit more benefit from volatility increasing. And because you have more long options than you have short, you actually want to put this on typically when volatility is relatively low and going to increase in the future. The short option gets hurt by the increase in volatility, but again, because the ratio, you have either 2 to 1 or 3 to 1, the long options gain more profit from the volatility rising than the option that you have short loses. So you're Vega positive. Again, if I go back, let me take off this spread, delete that position. Oh, wrong way. I'm going to delete that. And there we go. We go back. And actually, instead of this, let me just go out to, so there we go. So now I've got Tesla up, and let's say we're looking at the money right now. We're about 470. And I decide, well, again, I want to compare. So I'll just do a long call, and that's 7205, and I'll put that under analyze. And let me clear up the rest of these. Oh, try it again. Analyze. There we go. There's the long call. Okay. Versus, which I'm going to build, the ratio back spread. Again, go back and let's see, I'll do, I guess I could sell the same one here. Oh, no, I can't sell the same. Do that. Buy, buy. And move. There we go. Analyze. Now I've got them both. All right. And it looks a little funky because I've got both of these being shown right now, but if I can compare the two, you can see that if I want to do just buying the option, I'm paying a price of 71.90. If I do ratio back spread, all I'm doing is selling an at the money or near the money option, then buying out of the money options. And I buy the out of the money options because they're a little bit cheaper. I can zoom in on certain areas here for you just to show you the two different trade opportunities, the single long versus the ratio spread. The cost is reduced because I am selling an option to offset some of that cost. The Greeks are going to be different as well. Well, not so much the volatility. You can see, though, I have a positive vega. As a matter of fact, I have a little bit more positive vega than I did before because I have two long options versus just one. Yes, I have a sold option as well, but it's out of the money or at the money versus the out of the money options that are going to have that higher vega there. I also have time decay that's going to be working against me. And that's one of the reasons why I chose the options that I did. If you notice, when I go back to the option chain, I chose options that are going to be pretty far out in expiration. The ones that are closer in expiration will be a lot cheaper, but you're going to have more time decay, and that's going to be working against you because you're doing this position with more longs than you are shorts. So you want to be mindful that time decay works against you. So some of the big risks are whenever you sell an option, you run the risk of assignment. Okay, that basically means that the short option could become due. So if you sold a call, that means that somebody is going to buy stock from you. If you don't own that stock, you either have to exercise one of those calls that you bought, or you have to buy the stock and turn it over to them and either become short or buy the stock. So the greater in the money the option is, the more likely the assignment's going to be. So we want a big explosive move. However, that's a little bit counter because when you look at your risk profile, you'll see right here, if the prices go up a lot, that option that we sold is going to go deeper and deeper in the money. However, once we get past a certain point, our break even, it doesn't really matter because even if we get exercised and assigned on that short option, we could exercise one of our long options and cover it, and we're going to be in the money deep enough that we'll actually have profit. Okay. So we don't want to do this unless there's going to be a large expected move in price, either up or down. As you can see, we need quite a bit of movement. Right now, the current price of the underlying security is only at 470. In this case, I probably wouldn't do it, but our break-even price is not until 585, although that's at expiration. In reality, I do not hold this till expiration. Because I'm doing this as a debit, basically, I want to, and because I want this price to move, I'm playing the delta of the option. I'm going to need to exit this most likely when there's still at least 30 days left until expiration of the option. And you can see what happens. Right now, that's the blue line. My break-even price is much, much lower. Currently, my break-even price is around 470. Well, almost 480. But the longer you hold on to the option, the more this decays, and you can actually see that time going against you. So here I'll add an extra day, and I'll set that in the middle. And you can see halfway till the expiration, 46 days left till expiration. Look what happens with my break-even point. It's going from here, shifting right, and shifting right even further. Why? Because that time value is decaying. So the point is, I want to get into this. I do want to buy time, so that way I reduce the time decay that's going to be affecting me. But I want to get out of this position as quickly as possible, so that way my break even is as far left as you could possibly see, and I have the higher probability of profit with that big move if it goes in my favor. If you do this, sometimes you'll see that the risk profile, even if it goes against you, you can still make a profit as long as it goes down far enough as well, past the break even. So the maximum loss is basically the dead zone. The dead zone is if prices don't move as far as you expect it to. So that's what I was saying. If there's a specific event that you're waiting for, some sort of a news event or some sort of a, what you call it, the earnings releases, if it doesn't go the way you expected it to, you pretty much have to cut your losses and move on. So you can set up stop losses in your positions as well as profit targets. And you can do that once you are in an open position. I'll talk about that in just a little bit. So time decay does hurt you. And that's why we want to do this by buying enough time, but also exiting the position when there's still at least 30 days left until the event, so to speak. So if I were to go back once again, that's weird. Oh, I got disconnected again, didn't I? So now I'm back in. So hopefully this will start loading up the search. Like I said, it's got pretty loaded with the S&P 500 index. And what I could also do here is add a different list if I choose. It's pretty easy. So I'll save this one as ratio. And I can create another list real quick just to see if it'll populate and help me out here. So let's do add new page, symbol list. I'll just do the NASDAQ 100. And there we are. Oh, now it just popped up, this, didn't it? Oh, there it is. Okay, so of course, never mind. I don't need the new page. I saw the old one. Here we go. So now it's running the screen. And that's part of the problem. I think I don't have any earnings coming in. Let's see, greater than 15, less than 60. Let me minimize or take this one out and see if anything pops up again. Daily. There we go. I just need to apply it to everyone. Whew, okay, there it is. So now I got the NASDAQ 100 list populated here. And again, this, for some reason, it does normally work. I don't know why I don't have the list being shown right here. There we go. Next earnings date. Oh, that's why. Okay, never mind. I understand what I did wrong. The next earnings day is blanked out because I don't have that downloaded on this particular computer. So that was my error. In the workspace, there's a next earnings day indicator that needs to be on the computer, and I didn't update it on this one. So that's my fault for this. So I won't be able to do the scans, but that's okay. I can still show you the strategies as an example. So if I went on something like Humana real quick and take a look, I'm also, for some reason, not getting the implied volatility data right, but that's okay. Again, I can go in and we're gonna have to imagine that there's earnings coming up on this because that's what the scan will do. It'll scan, as you saw, for companies that have earnings coming up within the next 15, and I believe it's up to 45. I forgot to see what the default was. I changed it since we came into the class here, but basically we're looking for a major move that's going to happen. And what you typically want is some sort of security that's going to show a big move based on earnings. And this is one that may fit the criteria. You take a look back and you can see pretty much every quarter there in April, there in July, and they're in October. There are big gaps. Well, why is there a big gap every 3 months? Every 3 months? Probably earnings, right? So if we have an idea of the overall trend in which direction prices may go, of course, there's never a guarantee, but if we expect that there are earnings coming up and we're likely to get a big gap to the downside, for instance, in the downward trend, we could put on a put back spread ratio. Again, we would use puts, not calls, if we're expecting prices to move to the downside. So I bring up Humana. We're at 241 right now for the price. I could do slightly out of the money here and sell a put. Let me clear this. So I have calls that are there for some reason. So I have those puts, HUM 240 put. And let's see, we did 93 days. We probably don't need that much time, to be honest with you. Let me go ahead and close that one out. Because if the earnings are coming up within the next, I don't know, 60, let's say they're coming up in the next 30 days. If I chose the 65 days out, within the next 30 days, I'll still have 30 days until the expiration. So plenty of time decay that I won't have to worry about. Again, I go sell the 240s. And let's say I buy, depends on how big the move I expect. Well, if I do these 210s, actually, no, let's do this. I'll go buy, sell slightly in the money, perhaps at 245, and then buy. And you can see, well, I didn't quite do it for a credit, still a debit, but it's close. And again, there's my risk profile. Now we want the big, large move to the downside rather than to the upside. Now it's not the issues with the trading platform. It's my computer and I didn't have the setup properly. That's all. It has nothing to do with the platform. It's me. So I apologize for that. My other computer has the updates and I just didn't update the TradeStation on this one. That's all. You just got to make sure you do the updates. Anyway, what we're looking for, as I mentioned before, could be any major an earnings announcement or company event, some sort of approval, or we could have even done it on the Qs today. Again, we were looking for something to have a large move and big news movement. For here today, we had QQQ or even SPY. If I were to go down to a smaller time frame, say 5-minute chart, you see that big move that we had to the downside. Prior to that move, if you took a look at prices, let's say you look at a 30-minute chart today, prior to that news coming out this morning, or this afternoon, excuse me, right here, there it is. You can see that prices had gapped down a couple days ago. We're trading a bit sideways, but are definitely looking a bit weak. So if we were expecting a move to the downside, we could have put on a put spread, a back spread ratio. Again, you would sell an at the money put and then buy out of the money puts expecting a large move in price. Well, this one didn't disappoint, did it? We went down about $6 in price. So quite a bit of movement there. So we went a large move in one direction or the other. We should have average or low implied volatility. And going back to the workspace, I'm on the wrong spot. There it is. On the ratio back spread workspace, what you'll notice is the scan, which again, I just don't have the tool set up properly on this. I apologize. I don't know why I don't have the next earnings date up there, but when you have that set up, you'll see it scans for next earnings date. You want earnings more than maybe a couple of weeks out. And the reason why is the closer you get to earnings, the more implied volatility will start to rise. And then the next earnings date less than 45 days, you want to wait forever. Obviously, we want to have that major move happening relatively quick. This one is kind of interesting. Implied volatility range percent, IV range, is less than 40. What that does, basically, Jesus was nice enough to create an indicator. It's not being shown on my computer right now, but I think I have it. Let me just add study. There's two of them. One is for the, there it is, RS and CH. So let me zoom in. You can see it. It says IV range percent RS, IV range percent CH. RS means radar screen, CH means chart. And it's available in the downloads. But basically, what it does is it takes the historic volatility, which is basically the chart for the last 52 weeks, and identifies the range of historic volatility. Then it plots the current implied volatility against that. So that historic volatility, the 52-week high and low, is divided into fifths. And we want something that is in the lower range, so that way we have relatively low implied volatility that is likely to go higher. The reason why is, again, if we have more longs, we have shorts, we want that volatility to go up, and the value of those calls or puts that we bought will rise faster than the value of the one we sold would lose. And because it's a ratio, we want that volatility to rise and the value of those options to rise, because we could possibly sell those options for higher value than we purchased. So implied volatility should be relatively low or average. And that can be seen, as I said, in the search by that implied volatility indicator, not this one, implied volatility range percent RS. Again, let me take off the earnings ones for now. There you go. And you can see it brings up some numbers. Yeah, let me take that off. There we go. And that's the other problem is the implied volatility is relatively high right now for many of these. But we want them in the low range. But if the markets move too fast or volatility goes up, then it's not a strategy you want to employ. You want to employ it when the volatility is relatively low, getting ready to go up. We had EG or Everest Group. The other thing you could use to take a look at the volatility is one of the indicators. There's an implied volatility all options that's available as one of the default indicators on TradeStation. And basically what this allows me to see is the implied volatility, again, of all the options out there versus the average. You can see that we are currently above the average. Well, for this particular strategy, you prefer to be below the average. Why? Because when you're above the average, you're likely to be moving back down. When you're below the average, you're likely to be moving up. Once again, we want that implied volatility to be rising. It helps for the profitability of the trade. When you choose expirations and strikes, basically selling one at the money or in the money option. Okay, if you're bullish, you do calls. If you're bearish, you do puts. And selling an out of the money option, you get less premium, but it does lower your probability to be exercised. Another option, excuse me, I shouldn't say option, another alternative to reduce the possibility of early assignment is to use index options or European style options. Mostly index options are European style. An American style option, which stocks and ETFs are, they can be exercised at any time. European style options can only be exercised or assigned at the expiration of the option. So that means if you were to do this, again, expecting a large move with a Fed announcement like today, well, we could have traded $ SPXW.X. You'll see those are the PM settled S&P 500 index options once that loads up. There it is, S&P 500 PM settled. Well, we could build the same types of strategies using those. Let me go back to my analysis first and preemptively clear that. Go back. Options. And let's say we were expecting the large move today that we got. Could have built this. Now, obviously, it's in the past, but at the time, I could have done a put back spread ratio. Sold and at the money or slightly in the money put. Let's do 6,000. And then buy the out of the money options. And let's see, did I do that right? There we go. Get rid of the Humana ones. And make it 2. And notice this one's being done for a credit. Ratios, back spread. Let's see. This is zoomed way too much. What happened there? There we go. And we'll see the shape a little bit better. And the neat one about this, notice this is being done for a credit. So this would have been obviously something we would do before the news announcement, not after. And what you can see is on this option, if prices move down, we profit all the way down to 0. If they moved up, as long as they go beyond the break-even price, look at this. there's actually profit to be had. So you can profit in either direction if you do this for a credit versus a debit. The way you lose, as I said before, is if you're in the dead zone where prices do not move far enough in either direction. So that's one of the nice things about the ratio back spread is you can profit in either direction. One is almost unlimited. Obviously, with calls, it's unlimited because prices can go up forever. However, with puts, it's down to zero. But if you do this spread for a credit, I could still profit should prices rally. I can only profit the amount the credit is for the option. And the reason why this is going for a credit, if I do expect this for a credit, I typically have to go with smaller time for expiration. This has happened to be 0 DTE or today's options expiration. If I go further out in time, the premiums will be a bit higher and more likely to be doing a debit spread, which is fine. Sometimes you can get away with credit spreads even with more time. So what we're doing is we're going to sell an at the money or out of the money option. You can even do in the money, but remember, in the money, you will collect more premium, which may end up becoming a credit, but you run the higher risk of being early assigned on the option. Then you buy 2 or 3 options deeper in the money, and that allows you to have a little bit more volatility risk, but that also profits from the higher volatility increase. And you do have, um, well, again, you're not going to buy and have to worry about the assignment risk. It's on the sell side. So shorter terms decay faster, which is beneficial if you're looking for a credit. But if you're looking for a debit, you do want to have that time decay slowed down. And therefore, you should be in this position up until 30 days left until expiration, which at that point, you would need to unwind that position by buying back the option you sold and selling the options that you purchased, hopefully for a profit, but it could be for a loss if necessary. So again, you can go into the workspace as well to get more information on that. So looking at an individual call ratio back spread, let's take a step back and take a look at these individually. This is the risk profile for one. And you can see by selling the call, this was sold. It doesn't show the current price, but we would buy 2 out of the money options, sell the one at the money or slightly in the money possibly, expecting a large move up. And with calls, you have unlimited upward potential profit. If it's a credit spread, if you have downward move, the premium collected is going to be your maximum profit if it moves downward instead. The maximum loss, now that has to be calculated depending on how it is that you do this, either for a credit or a debit. But for a credit, it's difference in the strikes minus the credit received. That's how you define the risk. For a debit, the difference is this between the strikes plus what you paid, because you would lose that debit that you paid if you go to expiration. The break-even prices, again, and the nice thing is you don't have to do all the math. It's on the risk profile. If I do create one of these, again, I did the put spread just recently right here with us. We have what are called price slices. I can simply go and create price slices, set them to right now. Not expiration, right now. There we go. And I can adjust them. Let's see, where are we? I still want to zoom in on this more. Come on. It's not zooming anymore. Okay. That's too far. Where are you here? 6,000. There it is. And I can adjust this to see what is my break even on the upside rather than having to do all the math myself. And it's going to take too long to do it that way. So we'll adjust it this way. Oh, actually, there's no break even on this one for right now. It's on the close. Sorry, expiration. There we are. And there it is. Close. And now I can do the fine tune adjusting. And obviously, this is going to be moving as the markets are moving, especially today because it's extremely volatile. And on the downside, what do we have here right now? Our break even is going to be around 59.73. There we go. I put a line there. And I can even do at the last, which is right here, or put it to the max loss, which would be realized there. So again, I don't have to worry about the math. I can just go ahead and use this and these lines, the price slices, to adjust for them and identify them myself. But if you want to know what they are, this is it right here, how to figure those out. So again, we use the call ratio back spread by selling at or out of the money slightly, maybe sometimes slightly in the money. A call, we would buy 2 out of the money calls with the expectation we're going to get a large move to the upside. The put ratio back spread is just the opposite. Instead of using calls, we're going to use puts, but it's still the same frame. The framework's the same. You sell an at or out of the money, slightly in the money sometimes, depending on how much risk you're willing to take. You sell that put. At the same time, you're going to buy 2 out of the money puts with the expectation that prices are going to explode to the downside and you will profit from the value of those puts you purchased going up in value and the one that you sold not increasing as much. So the maximum profit is from break even to 0, as you can see, has an up arrow down to 0. And if you go upwards, if you did it on a credit spread, your profit can be the amount of credit if the option expires worthless. The maximum loss, if you did a credit, would be the difference in strikes, but you also collected premium, so that offsets some of the risk. If it's a debit, it's the difference in strikes plus the debit paid, whatever you paid. That is, again, if it goes to expiration. You do not have to go to expiration. Typically, with this type of position, you wouldn't, as I mentioned. And the break evens are going to be the short strike plus the premium received, or the short strike minus twice the difference between strikes plus the credit received. Again, the price slices make it easier for you to determine what those break even prices are rather than to figure them out yourself. So if we want to create this, again, you find the at the money price, sell an at the money or in the money call for a call ratio back spread, buy 2 or 3 out of the money calls. And in this case, you can see we were trading at 505 on the Qs, selling the 505 calls at 1942, buying 2 525 calls. So we're 20 points out of the money. But again, if you're expecting a large move, say 50 points or more, you should be able to go beyond the break-even price and start profiting from that. This was done for $1.14 credit. So the maximum loss would be the difference in strikes, 20 points, minus the $1.14. You can see right there, 1886 is the max loss. Maximum profit, if you go up, is infinite. Obviously, in reality, it's only going to go up so far. So what you could do is when you identify a target, again, let's say we have a position on, and I want to do the call side. So let me close this one. Again, under trade, close, and kind of answer the question that was asked earlier. What would you physically do to manage this once you're in the position? Well, options. And I'm in the 0 DTE. That's fine. I'll do that for today. Let's say I go out to my chart. And let's see, this is on daily. Let's just do a 15-minute time frame for now. And let's say we're expecting, I know it's not going up right now, we're going down, but let's say hypothetically we're expecting a big move up from about 59.80 to 60.60. Okay. Well, if I put on a call ratio back spread, I could go ahead and sell the at the money options right now about 83. I'll do the 80s. So sell the 59.80 and buy, let's say the 59.90s, and that's going to be a debit spread. As you can see, the price, I did 1, 2. That go. And yeah, there we go. We'll do natural price, which is 240. And I'll place that order. Actually, before I do that, analyze. And this is what it looks like. And then I'll place the order. And hopefully that filled. Oh, you know what? I know what I did wrong there. I wanted to do as a market order. That's fine. We'll just go to manage. Ratio spread. Cancel replace. And just to get in, market.
Order filled.
So it's in. I'm in that spread right now. Great. Now all I have to do is manage it. Well, in order to manage it, remember what I said before, we're expecting prices to go up. There it is, SPXW.X. It puts them as single options. I push them together. And there it is, my ratio back spread. And my open P&L is not so good because we need that big move. Okay. Now I can close this position by right-clicking on that. And it brings up my order to close the position. I'm just going to go ahead and do it as a market order, but I want to get out if one of two things happens. Number one, I click the activation rule right here. And what I could do is if SPXW.X, which is what we're in, goes up to or equal to my target, which was 6,000, right? You go back to that chart and I'm sorry, 6060. Or if it goes down to a certain amount, I wish to get out, I can do that as well. And that way we can limit my risk. So let's say if it gets to 6060, first of all, if I do the analysis properly on OptionStation Pro, let me hit cancel for now, go back to the analysis tab. And if we get to 6060, my theoretical profit would be about, is that right? 5,000? Yeah, about $5,700. So let's say I'm willing to risk $1,000. Well, what I can do is identify what price level that would be. So let's see, I've got these price slices here. And that would be at roughly, well, higher than where we are right now. Obviously, I have to give it some time, but if it starts going down, my max risk, or not max risk is hit a little bit higher from where we are now. So it's a little bit odd, but I can at least put in my profit target where I wish to get out. And if the move doesn't happen, again, you wait for whatever that event is for it to move. I can go ahead and then put in my stop loss at whatever price it is. Let's say it's 59.70, 59.70. Again, I have that exit rule right here. I go market order activation. If SPXW.X goes up and hits my target at 6060 or drops down to below 59.70, it will exit me from the position. I'll place that order. And you can see right here, ratio spread. It'll go ahead and close it out. Buy to close, sell to close. So it's buying the one that I went long, selling the one to two that I went, sorry, buying the one I went short on, selling the two that I went long on. But it will only activate if the price of the underlying security goes up to 6060 or drops down below 59.70. Hit yes. And that order should be placed. I go to manage, and there it is, received. So now I have my stop and my target, and I can go ahead and just set an alert for myself to let me know when it's time. If that earnings report comes out or that news report comes out, I look back and I see what kind of price movement we have. And if it's not more than what I expected it to be, I can go ahead and manually exit the same way. But it's just simply, again, going to this position, close this position, and just simply get out at whatever price it may be, win or lose. Or I just let the stops take me out, either way. But it's nice that you have that feature to be able to do that. So again, we just create that spread. This was the cues I was just showing you with the selling the at the money 505 call, buying the two out of the money 525 calls. You do this right now. The price was around 505. So you see it's way down here, but we're expecting a big explosive move generally caused by major news. Ratio back spread for the put side, pretty much the same thing. Sell at or slightly in the money put, buy two out of the money puts with the expectation price is going to drop dramatically, so that way you profit. And the underlying price is expected to go way down below those long strikes. If it doesn't, that's where you're going to be losing, obviously. If you do this for a credit, this one was done for a debit, but if you do it for a credit, even if prices go up, you can still profit as long as it goes up beyond your break-even point. You would just simply allow the option to expire worthless and keep the credit. If you do these for a debit, meaning you have to buy to get in, you must close out the position in order to retain some of that time value before you go within 30 days left till expiration. You can set up the activation rule to get out at a profit target or at a loss if you choose to, if the event pushes prices beyond a certain point. Or if you're disappointed, it doesn't move as far as you expect it to, again, you can end up anywhere on this risk profile, win or lose, and simply manually exit the transaction. But you should be done when there's at least 30 days left until expiration. So again, managing the position, this is answering the question that came up earlier. Identify support or resistance, exit when you hit that level. If you expect prices to bounce from that level, as long as it's far enough that you've made profit. If that support or resistance is not far enough that you'll make a good profit on this type of position, do not use this type of position. This is only for large moves in price. And often what a lot of people will do is if there is an explosive move, but you only move maybe 50 to 70% of what you expected it to, maybe it's time to get out. Perhaps you misjudged the amount of movement. You can use things such as average true range and volatility to identify potentially how far prices are likely to move in your favor and take profit, maybe 50 to 70% of that maximum profit. And as I mentioned before, you can figure out kind of what the price might end up being as far as the reward if you use those price slices. You just adjust them based on when you expect to get out. So again, if I go back as an example, and we'll do more of this in options replay as well. But if I go to my analysis where I have one of the positions here, ratio back spread, I can move these slices based on, again, perhaps this is the 0 DTE, but I was going to say if you adjust the dates, you can see where the purple, the blue and the green lines are. You can adjust to see potentially by the time you need to exit when there's more than 30 days left till expiration, what the price would be and how much potential profit you have. And you could decide exiting when you're roughly 50 to 70% of that potential profit, or if you lose 1/3 of that potential profit. So that way you can maintain a 3-to-1 reward to risk ratio. And you can automate that as I showed using the activation rule. So once you know the maximum loss you're willing to accept, it might not be the full amount. You don't have to lose 100%, especially if you do get a bit of a move. You manually exit once you reach that area, or as I said before, using the price slices, you figure out what that's going to be and put in your manual exit or automatic exit based on the prices hitting that level. Let's see, is there a facility in OptionStation Pro to scan for ratio back spread across all options? I believe there is in this. I'm not going to go into it too much, but the search, if you go in, you can actually look for different strategies right here. Ratio spread or back spread. So 1 to 2. You can project where the price is likely to be, when the expiration is that you want to exit. So let's say we have a certain earnings date, let's say January 8th, roughly, right? So the trade closing date would then probably be the 9th after the earnings, or maybe more. We'll do 10th. What kind of volatility are you expecting to change? Let's say we're expecting a rise in volatility from here by 7%. And yes, it can give me ideas of what we're looking at for trade opportunities. Absolutely. So these would be the back spreads on this particular symbol. Can you do it across different symbols? I'm not sure with TradeStation. I know you can do it with just the one. I'm not sure if you can just do it on this particular tool. There may be some other tools you could use. But typically, I would do the search, as I showed you before. Again, I apologize, I don't have this completely set up the right way. Those are on me. But with the scans, if you have all these tools available for you right here, you can go ahead and just find the ones you want to get in, because we're getting a big move that we're expecting, and then look to see which ratio back spread would be best on that particular security. So I want to thank everybody for being here. If you have any other questions, let me know. And of course, you can also email to get more information. As it was said before, there's plenty of good information available on the web right here in that page on the Options Education Center for ratio back spreads. I'm going to kick it back over to Jesus. And thank you, everybody, for being here. There's the email. I knew he'd put that up there for everyone. So thanks again for having me.
Thank you. Thank you, Brandon, for spending this time with us as well. It was a lot of information to digest, but very, very interesting at the same time. The article that I've referenced multiple times in the chat is it's an article that Brandon also drafted. So make sure that you visit that link. It has information about ratio back spreads. It'll have a link to this webinar recording. And it also has, all the workspaces and tools that Brandon was showcasing while he was using the TradeStation platform. So that's the one he's showing at the moment. So if anybody needs any information, yes, the email is right there. So send us an email and we'll get you the information you guys need. I'm not sure if you said this, Brandon, but we are going to take a break during the holidays. So in terms of, I believe that we have a webinar tomorrow, which is presented by David Russell. And I believe that's the last webinar until January. So January 6th, is it? Yeah, January 6th, the day that we resume with options replay. If you haven't had an opportunity to attend an options replay, it's a very interesting webinar because we go into practical examples. So make sure you mark your calendars for that date. It'd be great to see you there. Brandon, again, thank you for your time. Everyone that attended this webinar, happy holidays if I don't get to see you guys. And I'm looking forward to seeing everyone next year, okay? Goodbye, everyone. Bye, Brandon.